Okay, hello everybody. Welcome to Korean Lifetime Mentorship. And in this video, we're going to do a review of velocity banking and how to engage it with both a credit card and a line of credit. So I would call that a credit card and line of credit combo. I think what happens is some people, they listen to velocity banking videos for the first time, get their mind blown, and then they listen to the video, say, hey, the HELOC is the best tool for velocity banking, right? And so they don't think that they can do it with just a credit card, or maybe they might devalue a credit card because there's higher interest rates and everybody has access to a credit card. But my suggestion is to get all the tools that you can available at your disposal and understand the strengths and weaknesses of the tools that you have at hand. Now, before we get into the video, go ahead and click the link down below to Velocity Banking 101 if you want to get to a more basic deep dive into the strategy and you have no idea what it is, and then come back here to continue your studies. Now, let's just go over the strengths of both the line of credit and the credit card, right? And when we refer to the line of credit, we're talking about the personal, business, or home equity line of credit, a little bit different from the credit card, even though a credit card is technically a line of credit. So the strengths of the credit card is that you get cash back and you don't have to pay interest if balances paid in full. So that's huge, right? And so if you're responsible using a credit card every month and then paying it back, then you might get a little bit of cash back rewards points. And also, you don't have to pay interest. Now, what is the strength of the line of credit? It can be used to pay anything, right? So credit cards cannot be used to pay everything. You can't pay a credit card with the credit card. You can't pay a student loan with the credit card unless you're using plastique. And the good thing about the line of credit is you do have lower interest rates, right? So if you compare like a home equity line of credit, I have one that's 10%, and then I have credit cards. A lot of them are like 20 to 30%. Okay. But what are the weaknesses of the credit card? I kind of already mentioned already, the higher interest rates. So if you're carrying a balance, usually, they might charge 20 to 30% interest rates, which could be a little bit high for some people. So if you're paying like a $10,000 balance, you might, for a month have to pay at least maybe $200 in interest. And so it might be like $300 payment and then $200 in interest and $100 in principal. Now, and also you can't use it to pay everything, right? So if I want to, like I said, if I want to pay a credit card, I have to do a balance transfer and they'll charge me a 3% fee. Um, and I can't pay off a loan with the credit card unless I'm doing like cash advances or using a intermediary service like Plastique, right? And they'll charge me about 3%. Um, the weakness of the line of credit is that this is big, right? The interest, if you like go to your bank's website and you're on the HELOC section and you need like $10 from the HELOC, the moment that you transfer $10 to your checking account is when interest accrues, right? So this credit card has a floating period where you may not be charged interest at all, and that's huge, right? So you want the best of both worlds. And yet the other disadvantage of line of credit is that because usually you can't directly take out money from a line of credit. Usually, I'm not saying non in all cases you can't, but usually you have to put click a button in the line of credit website to put like $10 or $20 in checking account. So if you're trying to like time things right, it could be really tedious to have to time every single bill and put in your checking account from the line of credit, right? So that's why I put like it's tedious to do it that way. So again, combine the best of both worlds, use a credit card and a line of credit and take advantage of these strengths. So combine these strengths, okay? So let's go to our velocity banking spreadsheet. So I always say in every single video, what are two things you have to do in velocity banking? Number one is you have to write a budget, right? So let's go ahead and write a budget. And so let me just do this start from scratch here. Okay. So first thing we do is write our paycheck, right? $5,000. And then we write our expenses. So we'll just say $3,000 for this example. Checking and savings, we'll have 2,000. Cash flow, and again, I get that the checking and savings and cash flow are kind of similar, but when we're talking about velocity banking, we just kind of say it's zero, just because it's like we're not meant to touch it in that sense, kind of like a 401k, but not really. So, but again, if the income is more the expenses, that's a good thing. Having $2,000 in savings is a good thing because the average American, I think, like couldn't even get would be screwed in an emergency of like $400. Like I think they did a Federal Reserve study on that. Okay, so now once we've done our budget, we always have to make sure we do an expense breakdown, right? So expense breakdown is important. And when we do it, we have to list every single debt as its own line item, right? And why do we have to do that? Because every debt, whether it's a credit card, line of credit, or a loan, represents cash flow that's eaten away from us. And that's something that once we pay it off, it's automatically recovered. And so it's important to know every single debt that we have in the expense breakdown, right? So when we do that, we actually can combine rent and other, although I think it's easier just to kind of separate out, see it visually, because most people always know how much they're paying in rent, but they might not know how much they're paying in like food, gas, insurance, etc. Okay, so now that we have that, let's just kind of list these values. So again, 400 a month, 600 a month. Rent we'll say is 1,000, and then food, other, insurance, gas is 1,000. Although this may have doubled because of inflation, but we'll just say that we're in a good situation. We have $2,000 in our checking and savings every single month. All right, excellent. Now, step 2 is that we need our velocity banking tool, which is a line of credit. Now, let's assume two things, right? Let's assume two things. We have a personal line of credit at 25,000 and a 15% interest rate, right? And then we'll just say we have like credit card number 2, like one line of credit, and I'll just kind of put this over here. And then let's say we have another credit card at 30% interest, and we have maybe a $5,000 limit. Okay, so we have our main tool, which is the line of credit, personal line of credit, 25,000, 15%, and then we have a credit card at 5,000 at 30% interest. Okay, so once we have that, now we're gonna do our velocity banking style budget, which is almost similar, right? So $5,000 in income, expenses. So we're gonna hold off on that because we're gonna figure out how we can free up cash flow using our debt tools. Okay, so here we have two loans, a student loan and a car loan, 10,000 and 13,000, right? And so we see that they're kind of at the they're not at the beginning of the loan. They've kind of been paid off maybe for a couple of years. And what's an easy way where we can recover $1,000 of cash flow and easily pay it off, probably under a year, right? The easiest way is just to transfer the debt from here, from the loan to the line, right? And so that's going to be 23,000. So if we have $10,000 balance here, $13,000 balance, and then we're going to put $23,000 balance here. And so what happens when we do that? This goes to zero. This goes to zero, right? Rent is going to be the same. Other food, gas, insurance is going to be the same. So what happened here is that this is going to be $2,000 of expenses, right? $2,000 of expenses. We eliminated these debts. Now all we did was a debt transfer, but look at what happened to our cash flow. Our cash flow is going to be $3,000, right? So with our checking or savings, this is going to be zero because again, we're going to review the velocity banking strategy to understand why our checking and savings is zero. So the strategy is normally you put your entire paycheck into the line of credit, right? You put your entire paycheck into the line of credit, gradually take your expenses out, okay? Gradually take your expenses out, and then by the next month, your cash flow will decrease the balance of the line of credit by that amount. So it should go down about $3,000 by the next month. I know there's interest accrued. We'll kind of calculate that separately. And I know that technically that's not how you do it, but just for visualization to understanding, we'll do it separately. Okay, so what is the difference between doing it the way we've done it before, which is just using one line of credit, versus a credit card combo or credit card and a line of credit combo, right? So what we do is we look at the other expenses, the non-debt expenses, and ask ourselves, what can we pay with the credit card? Now, it's possible that you can pay your rent with your credit card. I have seen it before, but usually they tack on some like $30 fee, at least when I used to live in an apartment, to pay with the credit card. And so again, it may or may not be worth it to you to pay with this credit card, depending on your calculations. But let's say that the rent is going to be paid in cash, right? So we'll just take it out from our line of credit the day or the day before that's due, okay? But all these other expenses, right? All these other expenses, you could just pay it with a credit card, right? So you have a $5,000 credit limit on that credit card, and even though it's 30% interest, you're going to pay it off in full, because what you're going to do is a simple debt transfer one time when that credit card is due, right before that payment due date, and then you might get some cash reward points. Obviously, you do accrue interest while using the line of credit, but that's okay because you're not doing this, right? You're not, the moment that you pay for something with a credit card, interest isn't accruing. But the moment that you pay with a line of credit, interest is accruing. Not only that, again, it's tedious. You have to manually put money into the checking account, click that button in the bank's website to pay your bills if you're doing directly from the line of credit. Whereas if you're doing with a credit card, it's just a one-time payment, right? It's a one-time payment. You don't have to really keep track. You just have to remember to pay before the statement due or the payment due date. And not only that, because you're paying it off in full, this is like a way to hold off on paying interest and accrue a little bit of cash back, right? So what's the difference between doing the previous way and the combo? Well, all you have to do is just turn this into just a giant credit card expense, right? So credit card expense, this is all it is. So originally, if we're just using a line of credit, we're taking out things directly from the line of credit checking account. We may have all these expenses. It may be annoying to click the bank button every single time. But if we're paying with our credit card, right, we just make sure we do one transfer from the line of credit to the credit card, and then hold off on paying that interest, because if we had paid directly from the line of credit, we're accruing interest. But with the credit card, we're kind of holding it off for maybe about a month or so. And not only that, we'll get a little bit of cash back. So from the budget point of view, nothing has really changed. It's just more about the tools and the behavior of what we're doing. Okay, so now that we understand that, okay, so what's going to happen is that, again, we're going to put our paycheck here, right? So it'd be 18,000, and then it's going to go, it's going to go down 18,000, and then once we get our expenses creep up, it's going to go up 2,000. So this will eventually be 20,000. So all we have to do to calculate this is H2 minus 3,000. That's which is the cash flow, and then you copy and paste over and over again. So nothing has really changed from our last calculations, because we're still paying, even though our food, gas, and insurance, yeah, we're still paying from the line of credit. We're gonna pay the credit card instead, and we'll make one payment to the credit card. So what's gonna happen is that 1 month this is gonna be 1,000, and then you're gonna transfer the money from the credit card to here, and then this is gonna be 0 again, right? So it's just rinse and repeat. But there's nothing really different that we've done previously. Now let's take a look, right? So let's see how long it takes us to pay off the line of credit. So we'll say the first month is month 0. 1, 2, 3, 4, 5, 6, 7. We'll say 7 or 8, right? But about 7, 8 months. Okay, so to calculate the interest in the line of credit, again, this is not going to be the most accurate interest calculation, because the line of credit balance, or the interest, is calculated by the average daily balance. So we have to make an assumption, which is pretty incorrect, that the interest is based off the last month's balance. But it's not. It's based off the average daily balance of the last month. Okay, so to calculate it, or to estimate it, all it is just the previous month's balance, H2 times 15% divided by 12. Okay, so interest rates are quoted annually. To get the monthly interest, you divide by 12. And then you copy, paste, copy, paste, copy, paste. And all we do is just sum it up. So we do this, and then we'll pay about $1,200, and we paid $23,000 of debt under 1 year, right? So this is fantastic. And not only that, we're going to pay less interest in this, because the moment when we dump our paycheck, that satisfies the monthly minimum payment, and that the balance will be the lowest it'll ever be at that day. And then we could put all our expenses on the credit card, so we can delay the at least $1,000 expenses in the somewhat near future. And so we're definitely going to pay less interest. And not only that, we get cash back, right? So let's say we have a 2% cash back rewards points card. So we add 2% to, I don't know, $1,000. What is that, like $20 back to, well, $20 is better than nothing. I hope it's $20. Let me just calculate that. So if I paid $1,000 and I get 0.02, yeah, I get $20. So if I get $20 back, that's $20 less interest than I had to pay, right? So maybe I should put minus 20. It's okay, but we'll just assume that here, right, we're gonna pay at the max around 1,250. And if everything goes right and we time everything right, we actually pay less interest and we get an extra $20 from our 2% cashback rewards program. You know what's funny? And this is kind of random. I always thought it was funny how people got excited about 1%, 2% cashback, and somehow they forgot that the credit card interest is like 25 to 30%. But that's neither here or there. But obviously, if you don't carry a balance, it's good for you. But if you carry a balance, then that 2% is like, the credit card company laughing at you. Okay, so now you can see how easy it is to use the credit card and line of credit combo. Again, same exact thing that we're doing, except that all of our purchases that we can make with a credit card, maybe not the rent, but the food, gas, insurance, we put it on the credit card. We pay it on the last possible day before it accrues interest in full. We get some rewards, and then we just rinse and repeat, do the same thing we're doing it, so we're just only using a line of credit. Again, we want the best of both worlds, right? So I want to use both the credit card and line of credit combo. And also there's a saying that banks only lend you money when you don't need it, right? So some people think like, oh, I shouldn't get more credit limits just because I don't need it now. That's exactly when you should get it, because the moment that you need it is the moment where the bank's not going to lend it to you, probably, right? And that's why I have a lot of credit, because I really don't need it. And so the moment that I need to use it, I have my foundation of credit to be able to make the purchases that I need for my business journey, right? Okay, so this is Crane Atlanta Mentorship. I'm going to make a plug for the group. If you're interested in joining our group, go ahead and click the Google form link below. Some information. Also, if you're interested, if you want to email us, go ahead and click the About page of the YouTube channel. You can email us from there, and we'll go ahead and respond. Have a great day, and we will speak next time.